The golden rule of investing has always been just buy the index, which has been a pretty good approach for anyone who's done it. Most of people who trade are actually unprofitable. Most investors who don't just buy the index don't outperform it. So what is the reason to just not buy the S&P 500 or a broad index like VTI or something and just ride it out for a long term? The numbers are on your side. And it's not like buying the index is a terrible return. If you look at, these are the numbers for buying the index. Basically, this is like a 26 year period here, and it's 9% a year from 1996 to 2022. It's 6.8% adjusted for inflation. And if you look at the past 200 years, it's 6.5 to 7% return. So obviously, those aren't terrible numbers. 9% might not sound like a ton, but at least it's going in the right direction. Compounding that is amazing. Like that quote says, compound interest is the seventh wonder of the world, and it absolutely is. You can make a lot of money doing that. And I think another quote is, I think it's from the same person too. Like, those who understand compound interest earn it, those who don't pay it. So a lot of people might look at this and say 9% is nothing, guys. That's not even worth it, when most people, if they're trying to do it on their own, are making less than that, or even just losing money. But the S&P 500 has gotten a little bit of a change for this year, at least. You can see these 7 tech stocks command almost 90% of the S&P 500's gains, saying that the market's not so healthy. And maybe that's the case, right? But it does seem like this year, the only reason the S&P 500 is up the way that it is now is because of the big tech companies, which I don't think is too shocking from a lot of people. These are companies that just print money. They just know what they're doing, and everybody uses them every single day, right? So there's just no way that these tech companies aren't going to be extremely influential. They've grown to that state that they are, and it doesn't seem like they're slowing down anytime soon. You can see this chart right here. If you look at these numbers that they have going on, Meta, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia are up 44%, assuming that's like an average for those companies for this year to date. The S&P 500 is up 10%, and if you take away these companies from the S&P 500, it would only be up 1%. So that's obviously a massive, massive difference, where these companies up here, these 7 companies, are really the reason that the S&P is performing at all, at least this year. And this is obviously could be, 1 year where these stocks are just taking over, and the next year they don't do as well, but a different sector does well. That's the entire point of the index and investing in an index, is so that you're not so focused on that. But I do think that for like me, personally, I would always build a strong foundation of an index of either S&P 500 or just a broad one like VTI, and then focus more on Apple, Microsoft, the big tech companies who just literally print money. Like the Federal Reserve has a money printer, so does Apple. Apple's the closest thing to that you have in companies. And if you I focus on those bigger companies because I don't think they're going anywhere anytime soon. And so far, that strategy has actually turned out to be a pretty good one, because those companies by themselves account for so much of the S&P's gains, especially in this year. And overall in the years, it just seems like it's getting even more influential. You can see for even this year, it's the 7 stocks account for 88% of this year's gains, with the index up $2.4 trillion, 7% overall. Apple alone has $549 billion in added market cap, is by far the greatest of the 7 stocks. So Apple by itself is adding over $1 trillion in market cap to this, which is crazy. And I don't think anyone is looking at Apple and thinking, this is going to slow down. This isn't going to last. Apple, it's had its day. It's old news. Apple just continues going on. Everyone wants their iPhones. People owning iPhones has actually only gotten bigger. It's gotten a bigger share. I think Apple's the majority, or like iPhones are the majority smartphones in places like the US for like the first time ever. So it's still only gaining popularity. And obviously, if you look at the analysts here, them saying stuff like, narrow leadership in the S&P reflects a less healthy rally than one with broader participation. And then you got Morgan Stanley saying that, they have last week historical data disagrees with the notion that big tech companies are a defensive play, as their gains in recent weeks as cracks in the US bank system emerge may suggest cautioning against investing in the sector until there's a clear bottoming among the broader market. So these analysts obviously both pretty much saying the same thing, like not to invest, to stay away. But analysts, they are one of those jobs where you can constantly be wrong and keep having your job. It's kind of weird, but obviously timing the market doesn't work. So this person from a Morgan Stanley analyst should probably know that, but they ultimately don't really care. And they're saying, don't buy until there's a clear bottom. But usually when you wait for the clear bottom, you've already missed and it's starting to rally again. And then you got to ask yourself, do you buy now? Do you wait for it to come down? What do you do? It's just easier to dollar cost average your way in, buy either the index or these top stocks or whatever, and not try to time the market, because timing the market never works. And obviously these tech companies are absolutely massive. You can see the combined market cap of things like Google, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla is $3.16 trillion. And if you take a look at this chart here, you can see again, the green line is the S&P 500 index market cap minus the big tech market cap. And then the black one here is the big tech market cap. And it's actually just crossed. So big tech is obviously the majority of the market cap, or a larger market cap than the rest of the companies. All 493, whatever they're putting here, are bigger than all of those companies put together. So that is crazy to think that these companies are that big, but I still don't think that it's crazy to think that they're going to continue to grow and continue to go crazy, print money, and just be insane companies. So it is crazy to see the big tech is literally just steamrolling everything this year, and the sole reason the S&P is up 10% or 7%, whatever it is now, than what it would be like flatlined if they weren't included. But that's the whole point of an index, is that next year, maybe it's a different story. Maybe big tech is slowing down, doesn't trade like this, and then some other sector picks up and is reason for the S&P thriving and, going up that year. So ultimately, index fund investing is not going anywhere. It's still probably the best and easiest way to invest your money. But I think doing that and building a foundation of an index, and then maybe buying a little bit more big tech stocks on top of that, probably wouldn't be the worst way to go about it. So index fund investing is probably not going anywhere, and it's still a good way to just easily put your money in the stock market and invest that way. That's gonna do it for this video. As always, don't forget to smash the like button and subscribe, and I'll see you guys in my next video.